Hi, and thanks for tuning in for another episode of Ask Spurrell CPA. Today, what we're talking about is business plan template components. So the components of the business plan. And I have Denise with me here again. So Denise, of course, first employee here. So
Yeah.
how long has it been now, Denise?
Almost 7 years.
Almost 7 years.
Yeah.
7 years. So that's a long time. So we're finally starting to remember how to pronounce each other's last names correctly now.
That's right.
So it's Mitra and Spurrell, right?
There.
We got it.
Right.
Okay, we were just joking. We're going to assign each other numbers, but
Yeah.
we'll work on the last names. So, and the quote that comes to mind again. If you failed to plan, you are planning to fail. Benjamin Franklin quote. And the statistic is always businesses who do business plans, they're 50% more likely to grow their revenue. Once they recognize that the business plan is important, what are the components of that business plan? So we want to avoid that story where the business owner comes in and they're failing to grow their business, or they ran out of cash. So Denise, what do you think is important to ask? What questions should these business owners be asking when it comes to the components of the business plan?
Great. So what software do you use for the business planning process?
So we use it's a software called LivePlan. Really, it's a web-based software, so it's really good for collaborating. And it lets the business owner be able to take it home with them, put their vision for the company in there, and then come back and we can discuss it once they've kind of brainstormed into the piece of software.
So why do you use that software, and what did you use previously?
Well, you remember we used to have those Word documents and the Excel documents, and we'd update them. Really, I think the big difference between some of the business planning software that you can get now is you can update them a little better. So when you're using the Word documents or Excel documents, updating them can be a little bit of a pain, especially the Excel. You're chasing down formulas or the formula is broken. So you spend a lot of time when people just want to make simple updates to it, where the programs that have the formulas locked in, so a little more efficient.
So why do you start with an executive summary?
Well, so we have to remember, the executive summary is just that. It's the summary of the most important things. And so if you don't start with that, especially if you're looking for financing, the bank might not read anything else other than that executive summary. There'll be decision makers along the way who will only read the executive summary. And, so it's good to, get the most important stuff out first, and, also keep the business owners focused on it. When they revisit, sometimes they'll only read their executive summary when they come back to it. So.
Okay. So what are the most important parts of the executive summary that you start with?
I've really started to, this might be a little more recent. We've been prioritizing the mission statement. What is the business? What's the problem in the marketplace, and what's our mission to solve it? And then moving down from there, we're starting to look, what is the widget? So what is the product or service that we're selling? What's that average transaction cost? And what's the average transaction revenue? What's the average gross cost of that, and what's the gross margin? So that's usually where we're starting.
Great. So next you use a company overview section, and what's included in that? The
company overview section's really about who owns the company, when it was incorporated, who's the banker, who do you get insurance from. It's really probably designed more so for external parties. So if you're looking for financing, they're going to want to know who owns it, when it was incorporated, when the year end is. So it's really a section that's useful for third parties mostly.
Cool. So next you have the products section. How does this differ from the products and margins in the executive summary?
Yeah, great question. So we start exactly where we left off in the executive summary. So we start with what's the average revenue per transaction, what are the direct costs on that transaction, what's the gross margin on that transaction. But we group in the executive summary basically an average. So we're looking at the average service price. So you go through the restaurant example. They might come in and order the steak and lobster and wine, or they might order an order of onion rings.
Right.
So we have the average there in the executive summary, whereas in the products section, we're drilling down a little deeper and trying to examine what are the ranges of those transactions, what are the smaller transactions, what are the larger transactions, what's involved in the menu, if you will.
Okay. So then you have the market and risk analysis. So why is it important to identify risks?
a lot of times business owners, they actually know intuitively what the risks are in their business. They know what questions keep them up at night. And it's important to not sweep those under the carpet. It's important to actually get them out in the open and identify what your strategies are to mitigate it. Whether that be a human resource risk or a supply chain risk. Let's get it out in the open and let's identify solutions that we can deploy to minimize those risks rather than just hope they don't occur, right?
Yeah. So then you have a sales and marketing plan. So what are you trying to quantify here?
So a lot of business owners, they come with some decent marketing initiatives at times. Like they'll have thought out, how we want to market the business, but they're usually missing, the quantification of those marketing plans. So if they're going to drop flyers, how many flyers? If they're going to do networking events, how many networking events? If they're going to spend on Google AdWords, how much they're going to spend? So it's really, we're looking at, not just looking at what the marketing initiatives are, but how many and how much of each of those marketing initiatives here.
Cool. So then you have an operations strategy included, which includes milestones.
Yeah.
So what are the purposes of the milestones?
So the milestones are really going to drive the projections. So if we don't tie dates to these milestones, we can't give accurate projections. For example, when do we think the build out of the storefront is going to be completed? If we're looking at launching a website, when is that going to be launched? If we're looking at hiring a new key person, when is that person going to come on staff? We have to assign dates to these key milestones in order to get accurate projections.
So next you have staff and key supplier section.
Yeah.
What is one of the components of this section that is fairly unique to your planning process?
It's the calendar. So we actually put the time blocking of the business owner. We've gone back, we've done the time blocking video before, right? But we actually put this right in the business plan because we actually can't give accurate projections for a small business unless we know, when the business owner is going to work on these tasks. The contractor who wants to go from 250,000 to 500,000, he has marketing initiatives, but when is he actually going to do twice as many estimates? When is he going to do twice as many job site visits? We have to understand that actually fits into a calendar, or else our projections are nothing more than guesswork. Right. If we don't understand the main key person in the business. It's really significant.
Right. So then next are the projections. How long are the projections that you do?
Yeah, we're usually not going longer than 2 years. So we're kind of looking, 2-3 years is as far out that we're going to go, with the first year being the year that we're in right now. And the reason is because, when you try to project 5 years or 10 years for a small business, it's just too long. It's too speculative. It's not a good use of time. Too many variables are going to change. We're not Coca-Cola. We're not Walmart, doing those 5-year projections. They're just speculations. So 2-3 years is really as far out you need to do for a small business.
So when projecting the income statement, balance sheet, and cash flow components, do you project them monthly or annually?
We always go monthly, and the reason is especially in new businesses or where cash flow is tight in a business, that cash flow is going to be huge. And we want to make sure that even though it makes sense at year end, a lot of the initiatives, they start off slow. You have to put the capital up front and do an advertising initiative, and before the customers come through the door later in the year. So if we do them annually, the math could work, but when you start breaking them down monthly, you can run out of cash, and that can be, that's the second reason why businesses go out of business. They run out of cash. So you want to do those projections monthly. Because a lot can change throughout the year, and you don't want to get in a situation where your plan actually has you running out of cash halfway through the year and not know it because you did the calculations on an annual basis.
So in your experience, what happens when you project some financial statements, some financial statement components monthly and some components annually?
Yeah, what can tend to happen is people recognize that cash flow needs to be done monthly. Sometimes they have enough intuition to know that needs to be done monthly, but then they're a little bit scared away by projecting a balance sheet monthly. And what they end up doing is making a projection that actually doesn't make any mathematical sense. So in order to project cash flow monthly, you should have projected the income statement and balance sheet and cash flow monthly, because all three of those documents are going to tie together and they'll reconcile together. And that's your double check to make sure your calculations are incorrect. So usually why they don't want to project the balance sheet is because they actually truly don't know how to do a cash flow statement. Cash flow statements can be challenging even for rookie designated accountants will often get them wrong. So they can be a little bit complex, right? So it's usually they know their balance sheet is wrong, they're not certain on it, and ultimately it means the cash flow is wrong. You should have that certainty to know it's income statement, balance sheet, cash flow, they'll all tie together, they'll all reconcile together. That's how you know it's right. And you want to make sure that that cash flow statement is nailed down, and the only way to nail it down is to actually do the balance sheet that reconciles with that cash flow.
Right.
So I think that's what we have for today. As always, if you have any questions, feel free to leave a comment below, and we'd be happy to address any topics you like in upcoming videos. Thanks very much.